All right, it says it is recording. Let me make sure everything's working like it's supposed to. It looks like it. All right. Audio is right. Okay.
Good.
All right, we're good
recording.
to go.
All right.
Record. I still have not uploaded the other 2 episodes. At some point, I'm going to get to that.
All right.
I've been a little busy.
Okay.
I've been a busy little bee of late. So
cheers.
Cheers. Yeah. So what episode is this? It's like 5 or 6 or something.
Yeah, that's only 5 or 6.
So the stat I told you is like most podcasts don't make it past episode 4, like 95% of them. So
there we go.
We made it.
We're in the minority.
We are in the winner's circle.
Hey, don't smoke because you got a giant no smoking sign right behind your head.
Okay.
Yeah.
All right. That's funny. Anyway. All right. So a couple of folks were talking about they were kind of wanting a market update on the commercial side, and I'm like, well, Sean will be here in a little bit, but
yeah, I can do that.
Yeah, the conversation is, at least what we're seeing on the apartment side is the deals that are getting sold. These banks are not taking big haircuts. They're 95 cents on the dollar, or essentially what they have into them, which is 100%. And then on office, the only thing I'm seeing is like up there in Greens Point or some other.
So a couple interesting things that have come to light this week. So, and you may have heard this. So Marathon over on San Felipe is trading.
Oh, no kidding.
They I don't know the exact number. It's about 300 a foot. So nothing's traded for that price yet in a long, long time. So everything else has been trading for sub 50 here and there, one for 75 or 80. So interesting enough, it's trading for 300. There's another one.
Is that the contract? Is it under contract?
Yeah, it's under contract.
Under contract at 300 a foot.
Yeah, and it's a buyer, like it's a real buyer.
How big is that building?
$500,000, maybe a little more.
So 500,000.
It's a big one, but I mean, it's a nice building, renovated, good location, well known. So, it'll trade. Well, the good thing about that is nothing's traded like that in 18 months. Right. So everything's been trading for pennies on the dollar, $30, $40, $50 a foot. And stuff's still trading there.
Yeah.
But you're starting to see stuff, trade a little bit higher and such. So
check in with him right there.
We're at what you want to tell where we're at? Why don't you say
we're at Texas Tea Tavern for our I keep forgetting our camera is here.
Camera's over here.
But I've got the laptop set up over here. So this is our infield setup. So we're at Texas Tea Tavern happy hour. There's, I don't know, 15, somewhere between.
Yeah, about 15
folks here.
We had 89 show up?
90. I think we got to 93 signups.
Wow. So there's 3 more came in.
I think folks are going to start rolling in here.
Yeah, I think it's interesting because remember the first one was like 5.
It was like 5 of us. Yeah.
And then the second one was 10.
Yeah.
Last week got to about 15 or 20.
Yeah.
And this week, you probably have maybe 40, 50.
Or 40.
Maybe, yeah.
But
so it's growing.
So this is what I've said whenever we do these events. Like the first 4 or 5, it's going to be hit or miss. And then by like 6 or 7, we did one over at my little favorite bar down the street over here at Lazy Oaks.
Oh, yeah. I love Lazy
I'll
Oaks.
never forget. I don't know if you were there for this one, but it was like right after COVID, like stuff started opening.
Yeah, I was there.
And then it got so crazy. I think we had 100 people there.
Yes.
And the parking lot was full. And like the assistant manager comes out. She's like, you guys got to move cars because you're like blocking it. Like it was absolutely crazy. And then the owner, Chris, is a great guy. Like, Chris is freaking awesome. He's like, bro, you got to give us some heads up when you're coming. Give us the RSVP. So on Friday, they do a fish fry. So I think they're Catholic. I don't know what the deal is, but they do a fish thing on Friday. They ran out of fish in like 45 minutes.
Because you brought 100 people.
I brought 100 people. Yeah, but they ate something like 30 pounds of fish. He gave me whatever the number was. It's crazy. He's like, brother, just give us a heads up when you're doing an event here.
So we're bringing 3 times as much fish with us.
Yeah, we'll bring a lot more fish. So anyway.
Okay, so back to office.
Office space.
And the other thing is we're starting to see is more lease up. So more leasing activity on the office side. So office is starting to look better. If freaking Powell would drop rates just a little bit. And it's not that, and you know this, and maybe a lot of people know this. The Fed rate and mortgage rates for for commercial, don't really correlate.
No.
Right? It doesn't really correlate, unless it's a big drop, right? But what happens if that interest rate drops, what happens is more people become enthusiastic about growth, and they'll start hiring people, and they'll start expanding, and they'll start bringing people back to the office, and stuff starts rolling, which then in turn,
guys are like, oh, we need another building. We need a
we're at 5,000 square feet. Let's go take 7,000, 8,000 square feet, because we're seeing now some movement because people are more optimistic about the economy. Because right now, I think I was watching that the economist Peter, I can't remember his last name I was talking about. And he was saying, last one I saw him, I think he said it was like 1.72 is the current inflation rate, which is terrible.
Nothing. Well, that's like almost no inflation.
Yeah. So, anyways, and he was talking about other things, which I think I talked about before, which is debt and all that kind of national debt, which everybody gets a little freaked out. But there's no real reason to freak out about national debt. Our nation's so wealthy, it doesn't matter. It won't matter for generations before it really make a huge difference. But yeah, and then industrial still moving well. Has slowed a little bit, but still moving. We still got a lot of industrial. I mean, everybody's still rolling ball.
So I had a company reach out to me, and they said, hey, would you help us raise some money? I said, I don't know. What is that? What is it you guys do? Essentially be not as a broker, but like actually working for a company, right? And I said, well, what is it you guys do? And they said, we do sale and lease back. And I'm like, oh my gosh. So I said, I got a buddy of mine. I got two buddies of mine that buy and sell businesses. And on the buy and sell side, no one wants to own the real estate.
Correct.
So I told him, I said, look, if you're in a deal and it's a good, credible tenant, because they're already going to do the due diligence to buy the business, which is going to support the underlying real estate, right? So I said, look, if they don't want the real estate, why don't we put together a fund and go buy the real estate and we'll lease it back to you for 10 years? So I'm having a conversation with this guy. He goes, that's exactly what we've been doing for the last 20 years. I mean, it's a brilliant model. So their specialty is in liquidity events for businesses. So if you're, and they mostly do industrial, or light industrial. So they've got a facility, they've owned it for 30 years. So, hey, look, we'll buy it from you. Obviously, you get a big pile of cash for it, right? And then you're going to sign a 10-year lease. And he said, he went through kind of their business model. And it was, it turned out to be a really interesting deal. Hold on one second. I know our audio is working and our mic is freaking out. Here we go. I'm going to turn it back on.
There we go. Well, that was just an emergency break.
I don't know. Sometimes this camera acts a little squirrely.
Oh.
So
we just said we're doing stuff we didn't want you guys to see.
Yeah. There it goes. Sometimes it goes into a sleep mode. This is when you hire the audio visual guy and then you just blame him for all the mistakes.
Well, that's who it was. You can't see him. We got audio visual guys behind the scenes.
Yeah.
It was all his fault.
Yeah, but it was interesting. He said, yeah, we've been doing this forever. And it's, and like I said, it's so funny because I had this conversation with a guy a year ago. I'm like, why don't we just put together a fund? I'll go buy the real estate. You guys go buy and sell the businesses. Like, it makes total sense.
Well, yeah, especially you put them on a 10-year deal.
No, yeah, these are all 10 years.
Because then you hold it for 3 or 4 years. You go sell it to, you get a bunch of them together.
Yep.
And you go sell them off, right? It's one big package to a big institution. So
And
institutions love those where you're like, hey, look, I'm going to sell you these 10 properties that are all sale leasebacks. They've all got 7, 8, 9 years on them.
Yeah.
And I'll sell them to you. And by the way, you're going to make 7%, 8% returns. They're going to buy them all day long.
Yeah. And I didn't realize this. The other thing that this is when someone's doing really well. He's like, we really focus on depreciation. I'm like, oh my gosh. And so this is right after the big, beautiful bill passed. So So I said, have you poked and prodded your analysts yet for updates on the entire portfolio? Because there's huge changes that are going to take place there. And they said, yeah, we're talking about like, this is going to be great. Like, oh, this is going to be so awesome. So now they're in like freaking deal mode. Like they want to do a ton of deals. So it was a good meeting. Interesting business model, which is funny because, like I said, I looked at it like 2 years ago. I'm like, man, we could build a whole business around.
There's large equity companies out of New York. That's all they do.
Yeah.
I mean, they're buying big stuff, right? Like Amazon facilities, right? Amazon doesn't sell, but those type facilities.
So he told me that the biggest deal so far this year was AT&T. It was just under $1 billion. They sold $1 billion of real estate, and I think they just parceled it out to whoever had the funds. So AT&T's got a little more liquidity.
Yeah, but that's kind of the guys out of New York. That's what they'll buy, right?
Yeah,
they'll buy the AT&T stuff because they'll buy that.
AT&T ain't going
$20 million at a time, right?
Yeah, and AT&T is not going bankrupt. No. It's like a bond. I don't want to say it's so safe. It's almost like it really is.
It's really close. You can't get any closer
No.
without buying a bond.
Yeah, I don't think AT&T is going anywhere anytime soon, right?
No.
So, but
you know, I heard again from someone else talk about the residential market is downward spiraling, and you know, people are selling off their houses at low prices, and there is more inventory in the market than there's ever have been, which is accurate. It came out yesterday or before, but that doesn't mean we're in a downward spiral.
No,
it just means people have been sitting on the sidelines waiting for interest rates to drop so they could sell their house, and they finally given up. They said, forget it, I'm gonna put my house in the market, which is crazy that you would see that in June.
It is, because it's very last minute.
Very last minute. Only more last minute you get is July or August.
Yeah.
And for those people that may not know, the true buyer's market is usually around March to June is when people are buying, because they want to move. And if they're going to move, they want to have their kids start the new school end of August. So they're trying to get closed before middle of August. So they can have the kids in the new school. So, you know, someone that puts their house in the market in June, July has missed the market.
Well, you know, it's so funny. It's like, I always call it the breeders.
Yes.
The breeder cycle, right? So my joke is, like, if you go to places like it, really in and around Houston's a great example. Kingwood, Cypress, Pearland, like, don't get me wrong, Woodlands a little bit, but really it's like those markets that are like really family oriented. Katy, like certain parts of Katy, you ain't selling a damn thing in the winter.
No.
And in the
from August to January,
now they ain't a whole
good
lot
luck.
Going
There's going to be a very little small amount moving at the time, right?
Cypress the same way. Like, you may as well close up shop. But during that starting around spring break, everyone starts getting serious, right? It's like, well, we can go ahead and move. We might lease back the house. Kid's going to go from this school.
Well, they also want to get their house in the market too.
Right. Yeah. Yeah.
So they're like, all right. And everybody likes to look during spring break.
Oh, of course.
Right.
Yeah.
That's when you got time, right? Because you don't have time other than that. Right.
Yeah.
So I would, you know, I don't know this for a fact. It'd be interesting to talk to some agents that do a lot of business, that do a lot of inventory, to see. I bet you spring break week is their busiest time of showing houses.
Oh, yeah.
It's got to be.
Yeah.
Because everybody and their brother wants to see a house during spring break. Yeah. So you got that 2 week period in Houston, because the schools have 2 different weeks they go on.
Yeah.
But I bet that's because that, you know, if someone asks me when I put the house on the market, I always tell them March 1st. Put your house on the market March 1st, because that gives everybody a week or two to find it, and then go look at it over spring break, March, April, because they want to start under contract by May.
I've always said no earlier than President's Day.
Yes, I agree.
February, because that you can actually see it. There'll be this little uptick of just new listings. And you're like, what is that? Oh, they're getting ahead of it, right? Because it's maybe we'll close by April. Yeah. Right? Like, it's not that big a deal, right?
Well, and nobody's going to, honestly, nobody usually wants, I mean, they don't really want to close in April. Mm-hmm. They want to really close in May, June, July, right? No later. Most people want to be done by July.
Yeah. Oh, yeah.
But they got to sell their house. So you also run into the contingency, right? I'm buying your house if I sell my house.
Right? Or they do the lease back thing.
We do a lease back, yeah.
Like, hey, I sold this one. We bought the net. It's funny because it's like we sold ours on a lease back for 60, 90 days. Then they bought one, did the same thing, right? So everyone's kind of leasing their own houses until they can all move. So
yeah, but then all of a sudden, the one person that doesn't need to lease back buys, and it's a domino effect.
Yeah,
right, everybody can move.
Yeah, it's like, oh shit.
Yep. No, it's yeah, but I mean, I don't know what your take on it. I don't think we're not in a downward spiral.
No, I found an article. Let me see if it's on this. I can't remember if it's on my phone or on my laptop. It was really interesting. It's right. It was on Yahoo. You know what I did? I posted it on Twitter to Logan over at Housing Wire. Oh, here it is. Investors snap up growing share of U.S. homes as traditional buyers struggle to afford one. Nearly 27% of all homes sold in the first 3 months of the year were bought by investors.
I believe that.
That's got to be an all-time high.
Oh, for sure.
27%? That's freaking nuts.
I mean, I literally, it's funny because I bet you 75% of the rentals I do now, people will tell me when they come to see the house, yeah, I really like to buy it, but I just can't afford it, so I'm renting.
Yeah.
And, well, I mean, because, think about it. You go out and you buy let's say you're able to find a $250,000 house. Mm-hmm. You got to come up with a down payment.
Yeah.
That's what people struggle with. Right?
Oh, yeah.
Big time. And they don't want to pay, people don't want to pay 6.5% interest.
Yeah.
Right? They're like, I can't afford this. If the rates would come down to 4.5%.
Oh, or even 5 and some change.
Yeah,
right?
People you see a spark because people are like, okay, I can afford now to buy a house. I can afford that $250,000 house.
Yep.
Right. Which now, if you find something below 250, you're putting some money into it.
Oh yeah.
That's crazy low, but yeah, I mean, I just think it's, and I had a lunch with guys over all commercial banking for a bank 2 days ago, and or maybe it was yesterday. I guess it was yesterday. And he said he obviously watches interest rates.
Yeah, like a hawk. That's all they do all day, right?
Right. They're watching, they're looking, they're listening to economists and doing all that stuff. And everybody's kind of the same mindset. Powell has to lower rates September.
Yeah.
Has to, right? And so it's just a matter, is it a quarter or a half? And so what he said to me is he thinks the market will expect a quarter. And if a half comes across, it'll really spark the economy.
Yeah.
And then obviously they do another one in the fourth quarter, either quarter or half. So he said, we go anywhere from a half a point to a full point before year end. He goes, I don't think it'll be a full point. I think it'll be either half or 3/4 by year end.
Yeah.
But if we can move 3/4, that puts us in the fives.
I always got to look at the 10-year because that 10-year does that little gentle dance between
it does
10-year mortgage. So it's a 10 and a 30-year. But the other thing I always look at too is and I don't understand the Fed appointment. I don't say I don't understand it. My understanding is his appointment is up in 26, March of 26.
Correct. Yeah.
But he doesn't have to leave if he doesn't want to.
My understanding is no one can make him leave.
Right. Yeah.
Like once it's kind of like a sitting federal judge.
Yeah.
You can appoint them, but you can't get rid of them.
Right. Yeah.
Right. So, and there's a reason for that, right? Because they want autonomy, right? So the reason why the Federal Reserve Chairman it can't be removed by Trump, even though Trump says he's getting rid of him. Trump can't. He can't do it. He can make his job. He can make everybody hate him.
Yeah.
Right. Which he's pretty much done.
Yeah. Got that check.
Yeah. He made everybody hate him. But and he's also, obviously, Powell's made everybody hate him on his own.
Yeah.
Because of the way he's handled the economy is crap. But technically, if he decides in 26, gives a finger to everybody, says, I don't care what you guys are saying, I'm staying. There's nothing anybody can do about it other than suck it up, Buttercup.
Well, but I also agree, like, if Trump would just stop talking about it and talking trash to Powell's a banker at the end of the day.
Yep.
They don't like controversy. They don't like drama. Like, if you just leave them alone and ignore them, you'll see rates start to come down, and you'll see, and I know people hate that. We're like, well, that shouldn't be, how they decide. I'm like, yeah, but he still wants to maintain that air of independence, right? So it's like,
if the president tells me to do it, I'm not doing it.
I'm not doing it. Yeah,
because I don't want anybody to think the president has the authority to tell me to bring down rates.
Right. He looks at it as
political.
It's an attack on the institution. It's not an attack on me. It's an attack on the institution.
Which is sad. It's just because this is a political game.
Oh yeah.
It's a political standoff between Powell and Trump.
Right.
Yeah. And Powell's digging his heels in to make Trump look bad because he also knows that people blame the president more than anybody for a bad economy.
Right. Yeah.
Even though Trump has tried to do almost everything in his power to spark the economy. Right. Including the big, beautiful bill.
Yes. The big, beautiful bill.
You want to elaborate on the big, beautiful bill at all?
Well, so, all right.
People may not know what we're talking about.
All right. So I think the tax on tips and the overtime thing was such BS.
Yeah.
I was nonsense. Like, and if you read it, like the cap is $25,000 on tips. people are like, that's a lot of tips. I'm like, if you work at a high-end steak place, they're making $100,000 a year.
Dude,
Like those guys are doing really well.
I would think unless you're working like, I mean, even bartenders. Now, I know a bartender that works out in the middle of freaking nowhere to a bar that I go to when I'm in the lake.
Yeah.
Guarantee she makes way more than 20. She makes more than $25,000 in a quarter.
Oh, guarantee. Oh, yeah.
Right?
Yeah.
So she pays taxes the first quarter.
Right.
Right. So, but now if you're a part-time waitress somewhere, yeah, you're never going to make the $25,000. Or if you're working at Hooters or.
But you're so low income, you're probably not going to pay taxes on it anyway. Maybe both sides of FICA or FICA, but.
Well, even if you pay taxes, what you're in the, I don't know what the low tax bracket is, what, 16%? 4%?
Yeah, if that, but you'll have enough write-offs and stuff. Like it doesn't.
It kind of is almost, I think they made it $25,000 because it almost is, you really are only going to pay on 7 or 8 by the time you do write-offs and stuff, right?
Yeah, if that, right?
And so maybe your taxes are $400, $500, right, on 25,000.
But I thought the overtime thing was pretty funny because it's capped at 15 grand, and then everyone was like, "Well, who does overtime anymore?" And I'm like, "The entire energy sector, all those guys run on OT."
I have.
Oh, you got OT? Yeah.
Oh yeah, we have my guys. Oh yeah, my maintenance.
Oh, your maintenance guys? Yeah.
Oh yeah, they get those guys that will pull down. They'll double their paycheck with overtime.
Oh yeah,
right?
yeah.
And they, when we say, hey, we got an overtime job this weekend, we're going to work all day Saturday, all Sunday.
They're like, sign me up.
It's a rock paper scissors who gets to do it. And my guys that are in charge, my leadership guys, have to really make sure they spread the wealth, right?
Yeah.
But yeah, they could easily get.
I know some oil and gas guys that are like, it's a 4-hour minimum and they'll go in for 2 hours, 4 hours minimum. I mean, they're making time and a half, and these guys are $150, $200 an hour guys, right? I mean, they're making good freaking money.
I mean, all the trades, electricians, plumbers. I mean, a plumber gets a call on a Saturday and goes out. That dude may make $1,000 on a Saturday, right?
Yeah.
He goes out there and he works for 5 or 6 hours. Man, he may make take home $1,000, right? So, not including what's the markup is for the employer.
So on the parts of the Big Beautiful Bill that actually makes sense. Opportunity zones are now like a thing. There was a sunset provision, and now they're officially forever.
There's no expiration anymore.
So if you guys want to look up opportunity zones, I'm not going to get into all that in the podcast.
But if you really want to do some serious tax, if you really want to get some guys that got money to invest with you, go buy an opportunity zones because they get huge tax breaks. In fact,
the real trick is 1031 into the opportunity zone. Yeah. And you can do that with, like, let's say you've got a bunch of warrants or options, cash those out, then roll into an opportunity zone project. But again, I'll let you guys, if you have trouble sleeping at night, read that. It'll put you to sleep.
Dude,
but the deferred tax benefit is what really makes the most sense.
And the more you read, the more confusing it gets. I mean, there's a reason why they have professionals in opportunity zones.
So probably the easiest way to say it is, if you do it right, you can roll your capital gains for an eternity. If you do it right,
zero taxes.
Just keep rolling it. So it's pretty cool. And you'd be surprised how many opportunity zones are out there.
Yeah, there's a lot. I mean, there's a ton all over. I was shocked. I actually have a house in opportunity zone. Didn't even know I had a house in opportunity zone.
Oh, really?
Yeah, over in Port Arthur.
Oh, yeah, it's got to be. Right?
Yeah, on the east side of Port Arthur, west side of Port Arthur's opportunity zone.
Interesting. Yeah, that makes sense.
And I didn't realize I had two. Actually, I have 2 houses over there. Didn't even realize it till I was looking at opportunity zone map. And I'm like, I wonder if any of my houses. I started looking at all my houses across Texas City, Navasota, Houston, Port Arthur, Beaumont, all that areas. So, and I was like,
yeah, here we are.
Look, I got one. Yeah. And now that I'm thinking about it, I actually have 2 in that area. So, but yeah, again, we'd have to spend an episode and a half on opportunity zones if we were going to try to explain it. And then we'd still just confuse the hell out of everybody and probably give you bad information.
So accelerated depreciation with like 100% write-offs year one, those are back.
Yeah, that's nice.
Look that up. And then equipment that you put into service year one. I'm not an accountant, but you can write all that stuff off too. But anyways, there's a lot of cool stuff that's in there for business owners.
Yeah, and for real estate.
Yeah, for real estate. Yeah, real estate.
I mean, it's huge tax write-offs for depreciation and such in real estate. So, worth doing a I wouldn't do a deep dive into it, but it's worth doing a minor dive into there's plenty of probably other YouTube videos that go into an hour of the bill.
Yeah.
And how it can benefit you. And then once you hear stuff that you like, then go look that up and get more depth into it. But
this gets into a conversation like cost seg. Like when I talk to single family guys about the cost segregation, they're like, this sounds really great. I'm like, if your portfolio is not at least $1 million, it doesn't make sense. So when you go down this track of, opportunity zones and all that, like you got to have some money. Like,
yeah, you're buying
$100,000
in opportunity zone.
Probably doesn't make a whole lot of sense.
Yeah, you get the benefit, but it's not much of a benefit, right? And that's what I've got. That's why I wasn't getting real thrilled about it. But yeah, and that's not why I bought them there.
Yeah.
I wasn't looking for opportunity zones because when you're buying $100,000 in an opportunity zone, you're just, it's a good thing, but you're really not going to benefit a whole lot.
But if it's like you and a couple buddies kicking in $100,000 each, buying a really nice, I don't want to say really nice building because it's an opportunity zone for a reason.
Yeah.
Right.
But you're buying $1 million building.
$1 million building, you're kicking in a couple $100,000, then it starts to make sense.
Yeah. So, matter of fact, I was talking to my guy that does it's consultant in that, and I was asking him. I said, "What point does it make sense to do a cost set, right?" And he said, "Well, obviously for him it's always right." But I'm like, "Okay, but your fee versus what I'm going to say."
Right.
Yeah. He's like, "Really, it needs to be close to $1 million or more before you really want to engage me, right?" Unless, and here's the other thing: if you build a portfolio, you can go back and do cost segs on it.
Oh yeah, you retroactive.
So yeah, if you all of a sudden look up one day and you got 15 houses and they're worth $3 million, $4 million,
you go back,
go get a cost seg guy, right? And give them all the information. Make sure you get a good one. There's different kinds. There's guys that do it kind of on the side, and they basically just kind of hit high level stuff. And there's guys that really do a deep dive. They're a little more, but they're going to make up for what they get you.
So the guys that we had used, they're engineers and accountants.
Yep.
And what they'll do is they'll say, hey, your AC, and I don't know this because I've not looked at the tables in a while, your AC actually lasts 15 years. So they'll depreciate the AC. Or your lights are 7 years, your carpet's 5 years, your paint's 6. Like they will line item all of your future CapEx. It's really depreciation, right? So they will line item all your future CapEx depreciation by the type of material and product that's in your building. So that's really what that is.
Down to this, if you get the guys that really deep dive, it's down to the drywall screws.
Yeah, your drywall screw lasts this long, and studs. They nerd out pretty quick.
Yeah, it's an interesting thing to look at how deeply they dive into that stuff. But again, get over $1 million worth of real estate, go talk to a cost seg guy. You'd be surprised. You have to pay him $1,000 to do it. 1,500 or something.
I think our building, it was a couple $1,000, and
it's a building though.
Yeah, it's a building. Yeah, and then we did accelerated depreciation, and we wrote off a ton. First year because we did a huge rehab on it too, right? So we were there, and when Trump started in 16, we were there in 20. We bought the building, and we depreciated the hell out of that thing at first.
It's funny. And you know this, and I know this. There's several people on here know this, but it's interesting. I'm sure you get the same question on someone new wanting to get in the business.
Yeah.
Well, but how much should I try to make a month? I'm like, that's such a small piece.
Yeah.
Like, you want to turn a profit, but $200. Like, my threshold is minimum 200, but I'm not out there trying to make 500 or 600 because that's not. Like
that's not going to move the needle.
No, what moves the needle is depreciation, equity, right?
Equity's
number one. In my mind, it's equity, depreciation, rental income.
Yeah,
really, that's how you look at it. Like right now, I was looking at my portfolio, and I'm like, I have. Based on that, I will personally go to 70% on my loans, right? So I will only go to 70% LTV. But at 70% LTV, if I was to pull out about 6 or 7 properties right now, I could probably pull about $350,000 to $400,000 out of those in equity.
Damn.
Right. And it's just because I haven't done it in a while. I haven't done it since before COVID. So I'm like, okay, but I'm in this quandary of, do I want to pay 8% interest rates on some of these are at 4.5, 5, right?
Yeah.
So, but I'm still looking. But I mean, if interest rates get in the fives, and DSCRs get into the.
Hey, good to see you.
That's okay.
Either we're going to put you on the podcast, or you're not careful.
DSCR, DSCR loans. If I get a DSCR loan back in the, even a 7, 6.5 to 7, I would probably refinance them. So I'll probably wait to that point. But yeah, equity's number one. Depreciation. I mean, dude, I haven't had to write a check to the IRS in a long time, and I have a pretty good salary during the day.
I will tell you what I met with our attorney today, and we had a conversation about our CPA, and he's like, your tax savings will outlive you.
Oh yeah,
it is absolutely insane. So it's
and I'm going to ask you this question. You're going to answer just like everybody else is. If you had to go back in time and do one thing different, what would you have done?
Oh, bought a shit ton more.
Yeah. And if you talk to any experienced investor, that's the one thing they'll tell you. I mean, I literally was talking to a guy the other day. He used to flip. Unfortunately for him, his business has exploded. His day business, and so he just hasn't been able to flip it.
Time.
No, he's like, I don't have time, right? And so, which is great, right? But he said, I said, I'm going to ask you the question everybody asks: what would you do different?
Took a lot more.
Yeah, a lot more.
But a guy like that, like it probably wouldn't work for you, maybe for me, but you find a guy like that and go, let's partner.
Yeah,
you're making a pile of cash over here. You know this makes money. They know what they're doing. So when you send them, hey, I'm thinking about doing this deal, and they look at it and go, no, let's go do it. Like, fine, you fund it. I'll go do the deal, right? Yep. Those are the kind of guys you want to partner with because they just don't have the time.
Well, that's what I'm working on, partnering with them.
Yeah, it makes a ton of sense.
Oh, yeah, for sure. No, it does.
I'm Kevin.
Cool.
Nice to meet you.
What else you got?
Man, just trying to think what else has been going on. I think we're going to start to see more movement, especially in the commercial side. I think obviously on the office side, I think they're starting to level off on the guys that have kind of have to sell, right? Or they're going, or the banks, or they're basically kind of not true REO'd, but they're working with the bank, and they've decided to write it down a little bit, and they're going to go out and sell it. That stuff is starting to kind of burn off a little more. Still some out there. There's still going to be a little bit more, but a lot of it is transitioned. Still multifamily out there to buy.
We're seeing it every day. Now they're not crazy deals.
No, you're not getting
60%
on 60 cents on the dollar, 50 cents on the dollar. But you can find them at 75, 80% cents on the dollar if you look hard enough. Now they're going to have some hair on them. Yeah. Right.
You have to know how to rehab.
Yep. Yep. You're going to have some rehab on them. They didn't really do rehab, or they didn't do very good rehab.
Right. That's true.
But really all that's happened with those guys is their loans coming due, and they've owned it for 5 years, or they refinanced it.
The bank doesn't want to play ball.
The bank doesn't want to play ball. They're not going to give them a good rate, and their whole performance based on a 3.5-4% rate.
Or the bank comes back to them and says, we'd like to see a little more in reserves. They go back to their limited partners. They go, we're not doing a capital call. And it's like, okay, well, then we're giving this back to the bank. It's pretty simple.
Or they're okay, we're going to go out and we're going to dump it. You guys are going to get 50 cents on the dollar or 20 cents on the dollar for what you put into this. Because they still get a good margin out of it. It's not like they dropped. Yeah. And rents have gone up. Yeah. If they've trended with the market and increased rents. But then a lot of them also, I've noticed one of these that I'm looking at they're going to buy, they haven't kept up with rents, right? Because they haven't had to, right?
Yeah.
They bought the thing on a good deal. They bought it with a 4% rate on the mortgage. And so as long as rents increased 5% a year, they were good. Yeah. So for last 5 years, they've increased them 5% a year. The deal is the market's increased more than 5% a year in the last 5 years by significant on rentals. So if you can find those guys that didn't keep up with market, that's the ones to buy.
Well, it goes back to what you said. I think equity is the most important piece because at $200,000 house at 7%, you're making over $1,000 a month, $14,000, right? So you're making over $1,000 a month. Like your $200 a month cash flow, like who really cares? That pays for all the nonsense you're gonna have to take care of during the year.
For sure.
But when you hold that thing for 5 years, it's damn near double in value. Like that's where you're going to get your real juice.
Yep. No, for sure. And I try to pick out, like I said, I haven't done it in a while now. I need to do it, but I try to pick out 6 or 7 or 8 of mine. Go refinance and pull $250,000, $500,000 out of them. And mine aren't even that big. I mean, my houses generally are the values on them are currently 180 to 250.
Yeah.
Right? Like I'm not out buying $400,000 houses, right? Because I try to buy what most people can afford.
Dude, I ran into a fund that does nothing but 500 and above.
Really?
And I had a conversation with the executive team, and I said, where are you buying? Because there are some markets that make some sense. And he was like, certain markets in Florida, Dallas,
Oh yeah,
Scottsdale. Like it was all the higher end markets where you get, I think it's a lot of expat.
yeah.
Like, so someone's here for oil and gas, someone's here for up in Dallas. They're working for some big corporate. They're from Europe. They get a $7,500 a month allowance. They're renting the house for $5,000, the furniture for $1,500 a month, and the company pays for it. So I think that was their little secret. They only had across all those markets less than 100 houses, so it wasn't like some huge
That's still
portfolio.
$50-60 million in houses.
Yeah, it is. It's a decent amount.
And
of houses.
$50 million, hold it for 7 years, it doubles in value.
Doubles the value,
You
yeah.
got $100 million, you go to sell them. You just made your investors double their money back in 7 years. I don't know about you, but anybody that's making double their money in 7 years is loving life.
Oh, I know. Plus the cash flow, right?
Yeah, yeah.
Depreciation, everything else. So
Mostly depreciation. There's a little cash flow, but like you said, even those big houses, like even the $500,000 houses, it's not like you buy a $500,000 house and you make $2,000 profit a month.
No.
You buy $500,000 house, you're making $700 a month.
Right.
Instead of $300 on a 200,000 square foot house,
Right,
or $200,000 house, right? So it's not like it's exponentially better on the cash flow, but that cash flow you're getting, you put it right back into it.
Yeah.
I mean, really, if you're smart, you take all that, you bank it, so that when the tenant moves out and you got to replace the carpet, paint the house again, AC goes out, roof needs done, whatever, you got all the cash sitting over here. So yeah, you do a little bit of cash flow along the way, but you're not. But the pop is
that when you sell them. That's
I'm going to give you a 2 or 3% return a year for the next 7 years, but at the end, I'm going to give you 100% return.
Well, and the other little dirty secret about if you're in certain submarkets and you get really good at making offers and buying houses there, that's when you start getting the deals out.
For sure.
Yeah, you start. Then that house was $500,000. The house next door that needs $100,000 in work, you're picking that up for $275.
Yep.
Put $100,000 here for $375, worth $500 a day, worth $900. 5-6 years from now, you're getting even bigger equity pop. But that's kind of the little secret in those little submarkets.
For sure. No, and the markets you talked about.
Mm-hmm.
Dallas, Scottsdale, Florida, Houston has some of those. You go up into certain pockets. There's a lot of expats that live. Lexington's where I'm at. There's a lot of expats going there. A lot of expats from the oil and gas on I-10.
Yep.
Right. And if you go, there's a lot of other little areas off of I-10 where they go live.
Yeah.
They're coming in to work for 2 years, 18 months, 24 months, 36 months. And they're getting per diems.
Yeah.
Right. So they're moving their family here from wherever they were before. Because if you're going to advance in oil and gas, what you got to do?
You got to move. It's like the military. You got to move. Can't go anywhere. You got to move.
Yeah. But if you work for oil and gas and you want to move up, and you want to be an executive at some point, you're going to relocate every 2 to 3 years for 20 years.
Yeah. Yep.
Until you get to the point where you're high enough up that you can say, I'm done. I'm going to stay right here. I'm going to make my $1 million salary. And
that's right.
Peace out.
And I'm done.
Yep.
I'm done.
So, all right.
Well, hope you guys enjoyed the show.
We're going to go enjoy all the people drinking that without us because we're both out.
We are both out.
And there's plenty of people we need to talk to. So
cool. All right. Thanks for watching, guys.
What is it? So that 240 was 29.